Hello students, today in this session we are going to learn the most fundamental thing of accounting, that is golden rule of accounting. This golden rule of accounting we can say is the backbone of recording all the financial transactions which takes place in a business, be it journal entry, be it ledger or any other financial transactions which we record in the books goes through golden rule of accounting. So in today's session we'll be learning about a brief of introduction to accounting, meaning of accounting, debit and credit, classification of accounts, then we'll learn about golden rules and we'll also go through few examples of accounts. So let's start with understanding a bit about accounting. So what is accounting? It is the language of business. We can say this is the method how we record all our financial transaction in our books, be it bookkeeping or double entry. We have to record all our monetary transaction and it happens in accounting. So we can say that in accounting we systematically record, classify and summarize all monetary transactions. What is the main objective of accounting? The main objective of accounting is to know whether we are gaining profits, incurring loss, or if you also want to know that what is a financial position currently, then only accounting helps us know about it. So overall, accounting is a method how we monitor, how we classify and record all our financial transactions. Now let's understand the golden rule of accounting. The golden rule of accounting is nothing but a set of guidelines. These are the guidelines which are given to all the accountants and people who record the financial transactions. So they can follow a systematic record of financial transactions. Means if we give it to the choice of accountants or the people recording, they can record on their own by their own method. But if we want to have a similarity or if we want to have a comparison or to monitor that how different businesses are performing, we need to follow a standard guidelines. So this golden rule of accounting give us that set of guidelines which every business can follow. So they revolve around a system of dual entry. These accounting, as we know, or we can say the golden rule of accounting, it revolves around a dual entry system followed by debit and credit. So let's understand what is account, what is debit and what is credit. First, what is this account means? Account means a particular set of transactions of a particular nature being recorded under a certain phase. So a record of a transaction particularly for a person, for an asset or for an expense will have a separate account, and all the transaction related to these particular things will be recording at a particular place. So that particular place is known as a account. Now let's understand what is debit. Anything which comes in or a business receives is known as debit. Anything which a business is receiving is debit. So in contrast, what is credit? Credit, anything which a business gives. Debit, what it's receiving. Credit, what it's giving. Anything coming into business will be debited. Anything going out of the business will be credited. So this is the basic concept of what account is, what debit is and what is credit. Now to understand the golden rule of accounting, we should be familiar with three types of account. Means we can say that all the accounts which I spoke about, whether it's expense, whether it's related to asset or so, everything is classified under three vast categories. What are these three vast categories? Let's understand one by one. The first one is personal account. Personal account, any kind of account which is created for a person, be it an individual, be it a firm, any company, any statutory body, government, any kind of person. If we are maintaining one account for a person, it will come under personal account. Second one is real account. Real account is related to all the assets. It can be tangible or intangible. In business, we have two types of assets mainly, tangible and intangible. Tangible ones which we can see, we can feel, that comes under tangible, like for example machinery, cash, furniture, motor vehicle, all these can be seen, can be felt. So all these will come under what? Tangible assets. Intangible assets are goodwill, investments, all these are intangible. We cannot see or feel these kind of assets, but all these comes under the broad category of assets. So any kind of transaction happening in this classification will come under real account. The third account is nominal account. Nominal account deals with all the expenses, losses, incomes and gains. Any kind of expense we are occurring, any kind of gains we are getting, all these will come under nominal account. Now let's understand all these accounts one by one. So before that, let's understand what is the overview of golden rule. We understood that golden rule is a set of guidelines, but what are those guidelines and what these guidelines talk about? For real account, the guideline is debit what comes into the business, credit what goes out of the business. So any kind of transaction which deals with real account tells us that we have to debit whatever is coming into the business and we have to credit whatever goes out of the business. Personal account. Personal accounts rule or guideline is debit the receiver, credit the giver. If anyone is receiving money from us, we have to debit it. Anyone from where we are receiving the money, okay, we have to credit them. And the third one is nominal account. The rule or guideline for nominal account is debit the expenses or losses of the business and credit the income or gain of the business. So we are debiting all the expenses or all the losses and we are crediting all the incomes and gains. So overall what we can say, real account, debit what comes in, credit what goes out. Personal account, we can say debit the giver, credit the. In personal account, we can say debit the receiver, credit the giver. Nominal account, we can say that debit the expenses, credit the incomes. Now let's go with what is personal account and we'll learn about personal account in detail. What is personal account? A personal account relates to people, associations, companies or any kind of person, whether it is a group, individual or any firm, comes under personal account. Few examples are there. For example, government bodies, hospitals, banks, companies, cooperative and partnerships, drawings, account, creditors, debtors, all these will come under personal account. And what is the rule for personal account? Debit the receiver, credit the giver. So let's see few examples of personal account. The first example is that the business paid rupees 5,000 to Ramesh. Now here Ramesh is the receiver because business is giving 5,000 to Ramesh. So Ramesh is receiver. So what we know, that we have to debit the receiver. So Ramesh will be debited and what we are paying, cash we are paying. So cash will be credited. Second example, that the business received 8,000 from Shyam. So Shyam is the giver. Shyam is giving money to the business. So what we'll do here, cash will be debited and Shyam account will be credited. So we are crediting the giver. Again, another example, business gave loan to Ravi. So our business has given a loan to Ravi. Now Ravi is the receiver. That means that Ravi is going to be debited. We are going to debit the Ravi. So Ravi account debited to cash account. One last example we discuss before we move ahead, that a business took loan from bank. The business has taken a loan from bank. That means the bank is the giver, we are receiver. So bank is the giver, so bank has to be credited. So cash account debited to bank. So with these examples, what we have understood? We have understood that in personal account, all these people are having personal account. Ramesh is a personal account, Shyam is a personal account, Ravi is a personal account here, and the bank who is giving us the loan is a personal account here, right? So all these personal accounts, how we have treated? We have debited all the receivers who have received money from business, and we have credited all the givers who have given money to the business. So this is the transaction how we record in personal account. Now let's go to real account. A real account contains transactions related to liabilities and assets of a company. Means all the tangible and intangible assets which are there in the business are treated according to real account rule. So what are these tangible and intangible assets which are being dealt in the business? Like land, building, machinery, goodwill, patents, copyrights. All these are tangible and intangible assets which a business deals in. So all these accounts will be recorded based on the golden rule of real account, that is debit what comes in, credit what goes out. Means any of the money which comes to the business through these channels or through these kind of assets will be debited, and if the money is going out through these, then it will be credited. Now let's understand this also with a set of examples. The first is purchased machinery for cash. We have purchased machinery, that means the machinery is coming into the business. The machinery is coming in, that means what comes in has to be debited. Machinery is coming in, we have to debit the machinery. So the transaction will be machinery account debited to cash. Second example here is sold furniture for 10,000. So what we have done? We have sold the furniture, that means the furniture is going out of the business. If furniture is going out of the business, we will be crediting it. That means the cash account will be debited and furniture account will be credited. Here we see in each of these examples, it's not only one what we are dealing with. Means we are not only dealing with machinery or furniture, but with each transaction there is something else also being dealt with. For example, let's go back to the example one. Purchase machinery for cash. Means machinery is coming in, but when we are purchasing machinery, cash is going out because we have to pay through cash, and cash is also a real account. So the transaction will be machinery account debited to cash. So cash is being credited because it's going out. So in each of these transactions, a dual entry we can see, that one real account being debited, another real account being credited. Now next one, bought computer on credit from HP. So we have bought a computer, but we have not paid for it, but we are going to pay it later. That's why we have bought a computer on credit. From whom we have bought it? From HP. Now here HP is personal account because HP is a person with whom we are dealing here. Okay. So computer is the real account, it's a asset and it is coming into the business. So what we will do, that HP computer account will be debited to HP account. So computer account debited to HP account, and here HP is giving us, and we know we credit the giver. HP is giving us, so we will name to, we'll credit HP. So the transaction is computer account debited to HP account. One last example before we move ahead. Purchased building for cash. So business has purchased a building and paid cash. Now here one real account is building, another real account is cash. So building account will be debited to cash because cash is going out. So in real account, how we are dealing? We are debiting anything or any asset which is coming in, and we are crediting any kind of asset which goes out. So debit what comes in, credit what goes out. Next and third rule is related to nominal account. Nominal account contains the transactions of a business, namely expenses, incomes, profit and losses for a specific period. So nominal account contains all the transaction, because business runs with day-to-day expenses. Business runs on how we are spending the money. So all the spending of money will come under nominal account. So with all the expenses we are recording, we have to record all the revenues as well. So all the expenses and revenues will be recorded under nominal account. So what are the various examples of nominal account? Like commission received, salary account, rent account, interest account, discount account, all these will come under nominal account. So what is the rule for nominal account? The rule for nominal account is we debit all the expenses and losses and credit all incomes and gains. So we are debiting if any expense or any loss we have, we are going to debit it, and we have to credit if any income or gain we are getting. So a nominal account where all the expenses and incomes are being dealt, we are debiting the expenses and crediting all the incomes. Now let's understand nominal account with a set of example. First one, paid salary of 20,000. So we have paid salary to our employees worth rupees 20,000. So it is a income or it's a expense? It is a expense because the money is going out of the business. So it's an expense. So expenses are debited. That is what we have known or we have studied. So salary account will be debited. But what is credited? Because we know that every transaction will have a dual entry. One will be debit, one will be credit. So we know that the salary is an expense, it will be debited, but what is going out? The cash is going out, and the cash is real account. And if a real account thing goes out, we credit it. That's why it will be salary account debited to cash account. Second example, received interest 500. The business has received interest on any investment which it has done. It is worth 500 it has received. So receiving interest means receiving money, and receiving money is a gain. It is a income. So any kind of income we are getting, it will be credited. And in what form we are getting our interest? We are getting in form of cash, and cash is a real account and it's coming in. Anything what comes in is debited. So cash account debited to interest account. Specifically, if we see that how interest is dealt with, interest, anything which we are receiving will be credited. So interest is being credited here. Next example, paid rent of 8,000. Rent is a expense. Rent is not income. Here we are paying the rent. We are paying the money for the rent, right? 8,000. So any kind of expense or loss, how we are dealing with it? Any expense is debited. And what is going out? The cash is going out as well. So cash will be credited here. So the transaction is rent account debited to cash account for 8,000 each. Now let's go to the last example. Received discount 200. We have received a discount for 200 rupees. Now discount is something which we have received, means we have not paid anything against it. Okay, it is a relaxation which we have received. So it is a income or it is a gain which we have received. That's why it will be credited. So, cash account debited to discount account. Okay. So, these are the transactions which happen in the real account. So, these are the examples which happens in nominal account. In nominal account, what is the rule? We debit all the expenses and we credit all the incomes and gains. Now, let's understand why do we need golden rule of accounting. We need golden rule of accounting because of various aspects. Let's go through one by one. The first one, accuracy and consistency. If we follow one golden rule of accounting throughout the world, then it gives us more accurate answers. If we are following a set of guidelines, then there are rare or no chances of we doing a transaction wrongly, and every transaction is recorded based on these guidelines and will be accurate, and there will be consistency over a period of time. So, if we want to compare 1 year's data with another year's data, then it is easier for us to compare and find out whether the business is doing good or business has suffered any kind of loss. So, golden rule gives us a accurate and consistent information over a period of time. Second, simplified bookkeeping. If we follow golden rule, then it becomes very simplified for us to have to record or to keep any kind of transaction in bookkeeping. Our bookkeeping or recording transactions becomes very easy because we don't need to apply a lot of thinking or thought process that where a particular transaction will go, because golden rule has classified into accounts, and only thing which we have to do is to identify that one particular item in which type of account it will fall under. Once that is classified, it becomes very simple for us to record the transaction, and it takes very minimal time to do so. Then compliance. While recording transaction, or we can say to run a business, we have to follow a lot of rules and regulations, legal compliances given by the association, statutory bodies or government. So, while we follow golden rules, it helps us be in the line with every other business running around, and it helps us be in the legal scenario. So, if we are following golden rules, we are not dealing with any kind of illegal transaction, and all the transactions are recorded in a set way given by these bodies. Fourth, informed decision making. By following golden rules, when we are entering or we are recording our journal entries, ledger or other books, it becomes easy for us to identify our financial position, our business financial position. We exactly know that how much debtors we have, how many creditors we have, how the cash is being used, how much expenses we are making, from what sources we are getting income. All this information can be achieved through our books using golden rules. So, while we have the data in hand of all these accounts, all the transaction, it becomes very easy for the business to take informed decision. We can easily identify, we can easily take the decisions which are beneficial for our business. So, the managers will not be blindly taking decisions, they will be taking decision based on these accounts, and they will be having numbers, they will be having proper data in hand before they take any decision. So, it will not be a haphazard decision, but an informed decision with data. Next, it provides financial transparency and audit trail. It provide a better financial transparency, because all the transactions being happening in business, or all the transaction being taken care in the business, will be recorded. Every transaction following golden rule is being recorded. So a lot of transparency in the accounting comes in. So any kind of audit, any kind of inspection, supervision has to be done. It happens with utmost sincerity, because the transparency is there in accounts. All the transactions are recorded, and we exactly know how it is recorded, because we follow the golden rule. And the last and most important need of golden rule is that comparison of results. We are able to compare the results of our business with our other businesses. We are able to compare the result of this year with the previous year. So it helps us doing what? We can compare, and again it comes back to taking informed decisions. We will be able to take informed decisions if we are comparing the results with the competitors or with ourselves with various years. So we have learned about golden rules. Let's go quickly to see that what all we have learnt in golden rule of accounting. What is golden rule of accounting? So a golden rule of accounting is a set of guidelines that accountant follow for systematic record of all the monetary and financial transactions. And it follows what? It follows the concept of debit and credit. So what the different types of accounts which are being dealt in golden rule of accounting? Personal account, real account and nominal account. Personal account deals with all the persons involved in the business. Real account deals with all the asset and liabilities. Nominal account deals with all the expenses and incomes. So what is the overview of golden rule? What is the golden rule all about? Golden rule talks about real account. Real account, debit what comes in, credit what goes out. Personal account talks about debit the receiver, credit the giver, and nominal account gives the rule of debit the expenses and credit the incomes. So these are the basic rule of golden rule of accounting. So we also discussed about various examples of personal account, real account and nominal account. Then we also understood that why golden rule is needed, or what is the importance of having a golden rule. Golden rule helps us identify the need of that how transactions are being recorded. So it helps in maintaining the accuracy and consistency. It simplifies how we are recording in our books. It also helps us be in the legal compliances. It helps the business in taking informed decision making. It creates financial transparency and audit trail, and also helps in comparing the results with the competitors to identify our financial position, and also it helps us compare ourselves with various years to know whether we are growing or we are going down. So we have understood the golden rules of accounting.